Okay, let's get started. Good morning and welcome to today's Tuesday Markets Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I'm going to be walking you through my thoughts and analysis on the current market. So just a quick disclaimer before we get started. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, we'll be kicking off with the major equity indices. We have seen a bit of a bounce back higher, despite some pretty surprising jobs numbers on Friday. So we will take a deeper dive into that. From there, we'll be moving on to fixed income and commodities, as well as taking a look at the sector rotational model. We are seeing some pretty interesting rotation just in the last week or so. I'll take a look at a subsector of interest that I have for you today, and we'll end today's webinar with some bullish and bearish market observations. So the S&P 500, looking at the SPY ETF. And for the last few weeks, we've been looking at the 23.6 fib level on the weekly time frame at 420. And price has, as expected, declined to this level. And on Friday, we actually saw some pretty surprising price action. So Friday was the non-farm payrolls data announcement. So it's a jobs data announcement, basically. And what we saw was the data came out very hot. So the economy added around 336,000 new jobs, I believe. And was only expected to add around 140K. So it came out twice, 2 times as high than expected. And that's not necessarily good news given the current market conditions, because in normal conditions, more jobs, better economy, great, bullish market. Well, over the last couple of years, really, with inflation being this persistently high, a jobs report like that with more jobs indicates a tightening labor force and can lead to persistently high labor inflation, which is a key worry or key concern for the Fed. So straight away, my expectation was that that could be a strong enough bearish catalyst to break below this 420 level. But price didn't manage to recover. Also off the back of some Fed officials being a bit more dovish. These are just statements; they're not necessarily, Fed meeting notes or a speech by Jerome Powell or anything like that. But we have now seen that bounce higher in equities because of that. And their thinking is that with yields, spiking to quite high levels, they may not need to be as hawkish as they are or as aggressive as they are with regards to interest rate policy. Now, these are just statements, and I don't necessarily believe they should hold that much weight. I mean, what you really want to be looking at is Jerome Powell and his speech at the next Fed meeting. That's really the event that tends to set the tone for the next month and a half until the next meeting. Whereas a few statements from the Fed, what it is definitely giving some short-term support. I don't believe this is going to be a bullish catalyst or big enough bullish catalyst to see a reversal all the way back up higher. And we do already have price now at this key area of support at around 435 and also its 21-day exponential moving average. So let's see how price reacts to this level, because if there is bearish price action, that would indicate a reversal lower back down to 420. However, if we get a breakout from here, it opens the door quite nicely for a rally back to 445 and potentially even the 450, 455 area as well for the S&P 500. So we are at a critical time. And the big question mark for myself would be, are those comments, those dovish comments made by Fed officials, are they going to be enough to see this bullish breakout here for the S&P? And when you look at the technicals, sorry, my throat. When you look at the technicals, and if you just forego the fundamentals for a bit, it does make sense that we've seen this strong decline back to 420 and a bounce up higher. So it does a bullish view does align when you're looking at it from a purely technical perspective, but from a more macro and fundamental perspective, I still have my question marks. Let's see if price can actually break above 435, and maybe then we could see a continuation of the rally. But if it doesn't, look for a retest of that 420 area, which is a 23.6 fib level. All right, the NASDAQ 100 is performing quite well as well. Futures are pretty flat this morning so far, and just shy of the 370 area. So managing to stay above this 350 area of support. Remember, the NASDAQ 100 is largely comprised of technology names and high growth stocks, and it is outperforming the S&P, especially with now technology seeing some positive rotation, which we'll take a look at when we take a look at the sector rotational chart. The price is breaking above its 21 and 55-day exponential moving averages, and it does look like there's more room in this rally to move higher. But again, let's see if it can actually break above this 370 level, or if it's going to be some bearish price action and we continue to see a more bearish to neutral movement in equities. IWM, the Russell 2000 ETF, and price has now bounced up exactly off that 50% fib level at 170, major area of support, and showing some very good price action there, showing decent momentum already in just a short space of time. There is more room to the upside, especially when you consider that the next key area is all the way at 180. You can also look at the 21-day exponential moving average that could act as some dynamic support and resistance. But overall, I do think there's more space in the short-term rally for a rally back to 180, and from there, let's see if there's bearish price action. Just keep in mind, though, in the over the long term, small caps have been underperforming large caps in the last 2 years. So I wouldn't necessarily bet on short cap outperformance relative to large caps, but the risk reward does actually favor the upside, at least for the next few days. TLT, so with yields moving higher, bonds have been moving lower, and TLT breaking below that 88 level and almost reaching the next major support level at 82. Now, I have to zoom back all the way to around 2008 to get back to these levels. So that's why I actually didn't zoom that far. But right now, we are seeing the strong bearish trend. That's been a theme for pretty much the entire year. And you want to be selling into rallies. I just think we need to see a more significant rally before we look for a shorting position. Price was oversold just a few days ago, and it's just about recovered from that oversold condition. But you want to see more of a recovery, maybe back to 92. That will be a good time to look for shorting opportunities. But also keep in mind that area between the 21 and the 55-day exponential moving average does tend to act as some dynamic resistance as well. So short term, it is definitely oversold, but look for much higher rally, in my opinion, before looking for those bearish opportunities. Now, the US dollar has finally shown some bearish price action, but I am going to say that I'm not bearish on this just yet. Yes, this rally from 100 all the way to breaking above 105.50 is definitely looking a little bit overextended. It's not overbought on momentum indicators. The 50-period CCI only at 100. 200 is where I consider it to be overbought. But we are seeing that bearish price action there with a strong rejection of that 107 area. Now, looking at the weekly chart alone, yes, you'd be tempted to enter that bearish position, right? Or tempted to have a bearish outlook. However, when I look at the daily time frame, and especially when I look at the last few candles, intraday, yes, we are seeing red candles overall, but intraday, we're seeing price try and retest back to 107, back to 106.50. It's getting rejected there, but it doesn't seem like there's a lot of bearish momentum behind this move. I think that we could see price actually continue to move a little bit lower, back to the 105.50 level, but from there, we could start to see price find support and essentially establish a new major level of support at that 105.50. We saw price a few days ago already reject that level, and even today, this morning, rejecting its 21-day exponential moving average and bouncing higher from that. So there is still a lot of underlying momentum, but again, the weekly time frame does indicate a good reversal point. The daily time frame, I still have my doubts on. I don't think now is a good time to be too bearish on the US dollar, even though some Fed officials are making more dovish statements. You don't really want to have a long-term thesis based on that. All right, so looking at gold, moves inversely to the US dollar. And with the dollar pulling back, we have seen gold recover from a heavily oversold condition. 50-period CCI now at more modest levels. And like I said, the last couple of weeks, look for these rallies to sell gold because the dollar is still showing some strong underlying momentum. So we have this 175 level that was a major level of support. Price finding some upside momentum, but that's still a major level. And from a fundamental perspective, with a stronger dollar, I still think that gold is going to be under pressure. What I would be looking for is a rally back to above its 21-day exponential moving average, or in the area between the 21 and 55-day EMA, or 175. That's the rally that I'm looking for, short-term rally, and then from there, they'll provide an excellent risk to reward bearish entry point if we do see some bearish price action. Short-term momentum, which is a 6-period CCI, which is a red line, that has reached an overbought condition already. So short-term, it is, in the very short term, it is overbought. So it could be in store already for a reversal. And based off of futures, we are seeing, or pre-market prices at least, we are seeing that price set to open a little bit lower this morning already. So yes, double bottom here, clear area of support, but it doesn't necessarily mean we're going to see a full-on reversal higher here for gold either. And oil, looking at light crude oil futures. So oil has been on a strong bearish move in the last few days. We saw price reject that 93, 94 area, and very bearish week last week, managed to pop back up higher, rejecting its 21-day exponential moving average so far. So this could be another bearish entry point for me because this is very much looking like an impulse move to the downside, short-term retracement higher, followed by another leg lower. It does have this 83 area as support though, that we need to be looking at, but if it breaks below that, the next key level is all the way down here at around 78. So oil definitely under some pressure. You know, it did have a lot of momentum due to supply cuts, but it looks like that move has coming, or at least is coming to completion. On the other hand, though, if this 83 level does hold as support, what we could see is price essentially form a new trading range between 83 and around 93. So sector rotation, we have 6 sectors in the improving and leading categories, and we have 5 in the lagging and weakening categories. So energy has been providing leadership for quite some time, but it is losing out on some momentum relative to the broader market. No surprise there, given the fact that oil has continued to decline at quite a rapid rate in the last few days. So energy losing out on some momentum, but still well in this leading category. In the weakening category, interestingly enough, we are seeing technology find some momentum, especially off the recent price action here and the recent dovish comments. That's going to be a bit of a boost to technology. Let's see how long it could last for. Discretionary is still losing out, heading towards a lagging category. And communications as well, very stealthily, has been finding some improvements in relative momentum against the broader markets, heading back in towards the leading category. In the lagging category, we have utilities and staples very recently rotated back from the improving category back into this lagging category. And if equities do continue higher, or the major indices do continue higher, I do expect utilities and staples to continue to underperform. Real estate as well, heading in towards this lagging category quite soon, with industrials and materials very quickly losing out on a lot of momentum, like financials. So a lot of the names that were in this improving category were in this improving category for quite some time, but have now lost a lot of momentum. With the exception of healthcare actually managing to perform the best out of the 3 defensive sectors in healthcare, utilities, and staples, and still slowly trek its way towards this leading category. So taking a look at the subsector of interest that I have for you today, it's actually home builders. So the home builder ETF, XHB, I'm looking at a very short-term bullish play on this. So we had a bit of what I would call positive divergence, where momentum makes a higher low, as you can see here. So that's a higher low on the 50-period CCI. But we have price making a lower low. So where momentum made the previous low at around, let's say, the 78 area, and where it made its next low at around 74, price is making a lower low. So price making a lower low, momentum making a higher low, that is positive divergence. And it is a very bullish indicator. And we are seeing that bounce higher. So I do think when it comes to home builders, the trend is still bearish, so you don't want to necessarily be betting against the trend for too long. I do think there's a short-term move or short-term opportunity for price to rally back to 78 or 79. So again, very short-term opportunity here. Definitely a quick in, quick out kind of trade, because you don't want to be betting against the broader trend for too long. But we are seeing that positive divergence providing a good entry point, and also the small breakout above 75 as well. Moving on to some market observations. First up is Electronic Arts, EA. So EA is actually opening up a good bit higher this morning. It's a bullish idea. And the reason I'm looking at this as a bullish idea was because of this breakout above 124 yesterday. So we saw price make a double bottom at 118, and now breaking above that previous area of support turned resistance does indicate a continuation higher, targeting that 130 level. However, with price actually opening up a good bit higher this morning, you may want to wait for that gap fill and then look for a bullish opportunity towards 130 and potentially even higher, because if we take a look at this chart at the weekly time frame, we can see the previous swing level was all the way at 140. So if we can get a breakout above 130, maybe take partial profits at 130, but a breakout above 130 would indicate a continuation of this rally back towards that 140 area. Qualcomm. So Qualcomm was a bearish play. This was a credit spread idea, targeting this 114 level as resistance. We entered when price was at around that 114 level, showing some bearish price action. And so far, this is a trade that's going well, even though it hasn't moved that much lower. Because it's a credit spread, it does take advantage of that time decay working in your favor. So Qualcomm's still very much in line with our thesis, and you're probably closing in on taking profits on this name soon. Won't be 100% profit, but it should still be a good, healthy profit, given the fact that price is trading well below that short strike of 114. Okay, Dexcom. So Dexcom was another bearish play that we've had the last few weeks, with when price was at around that 104 level. Initially popped up a little bit higher, but then moved a good bit lower here towards 88. Good time to take partial profits around there. Saw retracement and a continuation lower. So if we are still in this trade, price is approaching that 78 level. We're seeing some bullish price action, but still very poor relative performance against the broader markets. If you look at the price action for the S&P 500 in the last 2 days, it has moved up quite a bit higher, whereas Dexcom is not finding that same momentum. So there might be a bit more room for a decline, but it is very close to major support. So I still think that it makes sense to be getting out at this current level. Also, momentum slowly starting to improve with the 50-period CCI making a higher low. IBM, another bearish play. So IBM, this is a long-term bearish play, but broken up to maybe a few trades, right? When I suggested IBM as a bearish play, price was rejecting that 150 level, was at around 148. We've had a strong move lower. I was expecting a more of a move lower towards 138, followed by a retracement higher, and then we'd take another move lower. So you take full profits at around there, wait for the retracement, and then wait for another, and then enter for another move lower. And this may happen, and one more time before it reaches our longer term downside target of around 120 to 122. However, what we have seen is price is actually finding some support at 140. So it hasn't quite reached that initial downside target of 138. And that's okay. I think it makes sense to take those profits now, look for some more bearish price action in the next few days, and then enter in another bearish entry point from there for another leg lower. So like I said, it's actually working out quite well for us, this trade, having a longer term bearish view towards 120, but it makes more sense to break it up into 2 or 3 bearish setups. And I think we've pretty much completed the first bearish setup. So great time to be taking partial profits and wait for some more bearish price action to confirm the next bearish entry. So new idea today, and that is Comcast. So Comcast, part of the communications sector, has slowly been improving under the radar. What we have seen though is a breakout here above 42, rallying towards 48, the next resistance level, but actually coming back to retest it. So running out of some juice there, coming back to retest it, bit of a gap fill, finding some support at 42 and immediately bouncing higher with some good momentum, recovering from an oversold condition. So a very good bullish entry point, in my opinion. And given the fact that the sector is showing some strength or improving momentum at least, I do think it makes sense for a bullish setup here, targeting that 47, 48 area once again. So let's see how this plays out over the next couple of weeks. And finally, we have Ford. So Ford is a bit of an ambiguous one. I do think it's one to add for the watch list for sure, because as you can see, price on the weekly time frame is now closing in on what is a major support level. However, it is also finding support here in the short term above 1150, which is the actual support level that we want to be looking at. It's already finding some support. So if you're a bit more aggressive, it does make sense to look to enter that long opportunity now. But there is also a chance the price does actually continue lower towards 1150, finds that major support, and then from there bounces up higher as well. So, if you're more conservative, you may want to wait for another short-term move lower before looking for that move higher. Also, earnings is coming up before the end of the month. So you could use this as an earnings play, given the fact that, price has declined quite a bit here ahead of earnings, and it may be a good risk to reward earnings play to the upside. With that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week ahead. I will see you next week, Tuesday, for another market outlook. Goodbye, everyone.